Hello and welcome. My name is Chris Cam with Mining Journal, and with me I have Rule Investment Media Chief Executive Rick Rule. Rick signed a partnership agreement with Aspermont across its finance event series to include the Rule Symposium and also the Mining Journal and Mining News Select series. Across those events, Rick's going to share his wisdom with us, but we have got a little bit of a curtain raiser in the form of this virtual series for you. Welcome, Rick.
A pleasure to be with you. Thank you.
In this interview, Rick, we're going to talk about an old favourite, M&A. There have been a lot of murmurings recently as commodity prices have started to turn. We've got Barrick apparently involved in talks with a whole bunch of groups, including First Quantum, who is also apparently being talked about with Freeport and Teck and Glencore, who are all talking about different things with each other. We've had a little bit of action in the rare earth space with Lynas and MP, I believe, and then we've had some actual consolidation in the mid-tier gold space. Do you see this as a logical time to be talking about M&A, and with prices apparently on the at the starting point of an upswing, is that going to be a problem in terms of consolidation?
Chris, it's always the right time to do M&A. We have way too many listed companies, and as an industry, we pay way too much by way of general and administrative expense. If you do a combination where the assets under management and the cash flow increases, but the general and administrative expense doesn't increase by as much, there is more money left over for customers and more money left over for shareholders. That's a very good thing. And equity markets, too, reward size and liquidity. So M&A, at least well thought out M&A, is always a good thing. Why doesn't more of it occur? I would suggest simple greed and larceny among managers. Nobody wants to be the CEO who gets left behind. Obviously, in consolidation, if you reduce G&A, those people who were the G&A that get reduced don't like it very much. That notwithstanding, it has to happen. As companies get bigger, their trading volume usually increases. As the liquidity increases, the share price goes up, which means the cost of capital goes down. These are capital-intensive cyclical businesses, and there is a virtuous circle. Management teams that have more assets to make asset allocation decisions across make better investment allocation decisions. Companies that have more sources of revenue tend to be more stable companies. They have more capital to reinvest for future growth. A wonderful, wonderful circumstance that doesn't occur anywhere near often enough. I am looking forward to the formerly Darwinian forces of the market forcing more M&A across what has traditionally been a recalcitrant industry, interested more in salary than shareholder return.
I'm not sure we're going to see that, Rick, if I'm perfectly honest. Usually what we see when prices go up, it's easy to raise capital and we see more companies springing into action. What do you think needs to happen to start encouraging some real M&A? I think throughout probably the middle to lower parts of the market where the management skill sets and expertise probably aren't nearly as strong as they need to be to deliver anywhere like real value for investors.
I think you may be seeing it right now. I think the fact that share prices aren't rising at the same time that commodity prices are rising are suggesting that the shareholders are beginning to hold the managers to a higher standard. The investors' outlook for the future is, I think, mirrored in the very low share prices that plague the sector. If investors in the sector begin to act more like owners, which is to say, if they begin to force M&A, then I think that M&A will occur. But I think it's incumbent on investors to look at the companies that you invest in. Are there large change of control premiums built into the management contracts? In other words, do the managers get incented perversely for lower share prices, as an example? Investors need to begin to act like owners. And that's one of the things that I'm really looking forward to participating in your conferences about helping investors act like owners, helping investors understand what their self-interest is. Too many investors believe that share prices are somehow ephemeral, that they aren't connected somehow to value. That isn't true. The answer to the ills of the industry are all at the hands of the owners. They are all at the hands of the shareholders. Understanding why you own something, understanding how management's actions can beneficiate what you own, and then causing that to occur in a very real sense are one of the keys to making money in the natural resource sector in the next decade. And I look forward, in my own small way, with the Mining Journal, at our conferences to being part of that process.
You touch on share prices not necessarily keeping up with rising commodity prices. Specifically, we've talked to you in the past about what's happening in the gold space and this disparity between lagging share prices and a rising gold price. Is that making the gold sector the obvious place for a first phase of M&A and consolidation throughout the market?
I think it will be a place, but the truth is that consolidation is needed everywhere. Perhaps not in the minor metals where there aren't very many entrants, but I suspect, as an example, that amalgamation will need to take place in the lithium space where there won't be enough capital for everybody to survive, where assets will only be beneficiated with lower general and administrative expense. I think that gold might be a place where it does occur simply because of the yawning gap between the increase in the gold price and the increase in the gold shares. And mining is gold mining has been a real refuge for lousy managers for a very long time. And I think that gold industry investors need to take the reins in their hands and really force consolidation. And I'm fairly confident, Chris, that that will take place this cycle.
Okay, and just finally, Rick, you touched on management or executive remuneration structures there. What else should investors be looking at if they're looking to try and position themselves to take advantage or protect themselves in some cases from a lack of or for an acceleration in M&A activity?
Well, Chris, first of all, the discrepancy between price and value in the shares. I think that's an important thing. Investors pay slavish attention to the price because it's easy information to get hold of, but much less attention to value. Price is only a relevant statistic if you have some feeling as to the value and to what the value might become. So in a small stock, as an example, what you are really investing in is the management's ability to answer some unanswered questions around the deposit. Increase the certainty with regards to the market's understanding of the value. If that's best achieved under a different wrapper, or if the management team doesn't understand their own value proposition, either don't own the stock or change the managers. This whole process of investor education around understanding how money is created in mining and as a consequence how it's made is really the thing that I'm excited in talking about at this upcoming conference series that we're doing with the Mining Journal.
Rick, that's all we've got time for, but we will be touching on that educational process among a bunch of other things that we consider the most relevant for investors in the market at the moment, and we look forward to speaking with you then in Miami, in London, and in Perth and Sydney.
Chris, I look forward to visiting with you and your subscribers across all those venues.